All right, welcome to a brand new week, traders. It's going to be an absolute monster one for the markets this week. We've got a few key economic data points coming up for the US this week, like the ISM manufacturing PMI on Wednesday, ISM services PMI on Thursday, and obviously the big guns coming out on Friday with NFP. But what we also have in the mix as a big risk for the market is the quote-unquote Liberation Day tariffs that is expected to come into force on Wednesday, the 2nd of April. So let's quickly touch on what happened last week. Last week, we had a bit of a downside bias for the euro dollar, which played out very nicely with the euro dollar moving back down towards that 200-day moving average, which was also very close to the weekly implied volatility low. As we got into that level, we saw the markets bounce to the upside. We always knew that that level of support will be a very tough nut to crack for the euro dollar, provided us with a very good opportunity to move down right into that level, obviously providing some profit taking opportunities. And then we saw a very decent bounce to the upside for the euro dollar, breaking back above that 5-day moving average, which, as you guys know, is just showing us 1 week price momentum. So where does all of this leave us then coming into the new week? Well, for the new week, it's not just going to be a dollar focused or euro dollar focused week like last week. Equities will also be a key focus point, because on Friday, we just had a complete meltdown in equity markets once again. I mean, take a look at that big flush lower that we had in the US500. Also saw a big move lower in the NASDAQ. The Dow push lower was even enough to drag European equities lower alongside them. We can see a big move lower here in the DAX, big move lower in the EURUSD 50, and obviously a big pop to the upside in volatility in the form of the VIX, which is now trading back above 21. So what was the trigger for this big move to the downside? It all came on the back of, you guessed it, US economic data and obviously tariff risks in the mix as well. On Friday, we had the University of Michigan consumer sentiment revised down to 57. Now, this was a big shock for the markets. I mean, we already pushed lower quite aggressively with the initial or the preliminary print, but that revision down to 57 really caught the markets by surprise for two reasons. Firstly, we saw yet another push to the upside in US consumer related inflation expectations, which is obviously still showing a lot of stagflation fears among both businesses as well as now consumers. And the other thing that, made this quite aggressive was the fact that we now have across the aisle, we're starting to see sentiment deteriorate, because what we've been seeing over the course of the last few prints now is that you tend to see Democrat voters voting showing a lot of bad sentiment for the economy. What we started to see, or we saw slightly more optimism coming out from the Republican side. That wasn't the case with the downward revision. We're now starting to see across the aisle sentiment really deteriorating here among consumers. We also saw 2/3 of consumers expecting quite a big bump in the unemployment rate for this year. And that, I think, was the highest number that we had since 2009, which was, of course, just after the global financial crisis. So there's a lot of focus right now on the consumer. The consumer, based on this data, is not very confident. There's a lot of bad sentiment in the mix, and that makes this week's economic data very important, because when you look at things like consumer confidence and the University of Michigan consumer sentiment, that's obviously based on the consumer. What the markets will want to know this week is how this sentiment is potentially impacting things like businesses, right? That is where the ISM manufacturing PMI and non-manufacturing or services PMI comes out this week. It's going to be absolutely critical for the markets to watch this. We saw the ISM manufacturing PMI obviously just scraping back above that 50 barrier or 50 level with the prior print, but we did see employment as well as new orders dipping back down below that 50 level. The reason why that 50 level is so important for things like the ISM prints or any PMI print for that matter is that any number above 50 shows us industry expansion. Any number below 50 shows us industry contraction. So that's a very, very important marker for the markets to watch. And coming into the new week, looking at things like expectations for these numbers, we can see, looking at the ISM manufacturing, markets are expecting the main headline to dip back into contractionary territory. We're not expecting a contractionary print for the services number, and that, I think, is where the bulk of the focus will come into this week. If we were to see a very big move to the downside, much bigger than expected, deeper into contractionary territory for manufacturing, And at the same time, if we also were then to see a similar type of move into contraction for services, I think the markets will be very unforgiving from a risk sentiment point of view if we were to see these numbers dipping back below that 50 level. If we see that, we would expect to see massive downside for US equities, massive downside for the US dollar, because that'll just exacerbate those fears and concerns about stagflation in the US economy. Vice versa though, if we, despite the data that we had from the consumer side on Friday, if we were to see businesses showing us more optimism, if manufacturing, for example, was able to stay above that 50 level, and we saw upward revisions for things like employment and things like new orders, and obviously if we were to see services staying put and remain above that 50 level, maybe even see a move to the upside, that'll show a lot of underlying positive sentiment coming out from the business community, and the markets will take very kindly for that. That could provide a very decent pop to the upside in the likes of the US dollar, and obviously some potential recovery for equities as well. The other risk factor that we need to watch is obviously NFP coming up on Friday. Now for NFP, I think it's going to be a very, very key one as always, but that 100 level is really going to be important. The markets are expecting this. If we quickly go to expectations for the week ahead, we can see that the markets are expecting NFP to print at 140, which is below the prior of 151. I think any number below 100 is going to be taken very negatively by the markets. If we were able, though, to see NFP stay around that 150 mark like we saw last month, and again, assuming we could see potentially, still decent numbers coming out from the ISM, that could provide the dollar with a bit of a sustained recovery, if you will, over the course of the next week or so, if we were to see that data coming in good. It's important here to understand that from a positioning point of view, the markets have priced in quite a lot of negativity for the US dollar in a very short space of time. We're looking at the COT data here updated on Friday, and we can see that the dollar is still sitting on a very decent net short position here, looking at the dollar aggregate. So if we were to see much better than expected US data, it could provide the dollar with a bit of a bounce. Taking a look at key levels then for the likes of the US dollar, if we were to see positive data points coming out, we could potentially aim for a move back up towards that 104.50 psychological level. We do have the implied volatility. Let's just see where the weekly level is sitting. For last week, we were sitting a little bit lower. This week, we're sitting around that 105.50 for the weekly implied volatility number. That could be a possible area to aim for if we were to get really good data. That's also the low going back to December the 6th. So that could be a possible area to aim for. However, what if the data comes in terrible? What if we see massive downward revisions for services, massive downward revisions for manufacturing? And obviously, if we were to see NFP dipping below that 100 mark, look, first area of support to aim for would be the low going back to the middle part of March, which comes in around that 103.30 level. Below that, we've got the weekly implied volatility low coming up around that 102.60, which is also a key support and resistance area for the dollar going back a couple of months now. In terms of euro dollar, very similar to last week, we've got a couple of key levels to aim for. The key support in the case of very strong US data this week will be a retest of that 200-day moving average, as well as the prior weekly implied volatility low. We've got the new one coming in a little bit lower this week, not too far away though, around that 107.80, 107.90 level. It's basically a very strong level of confluence of support here around that 200-day, as well as the implied volatility low. And then obviously in terms of very bad US data this week, we could potentially aim for a move back up towards the prior highs for the euro dollar around that 109.50 psychological level, also marrying up nicely with the implied volatility weekly high for the week. Now, the other risk that we need to watch apart from the US data this week is of course Liberation Day tariffs expected on Wednesday. Look, at this stage, it's almost impossible for markets to define and limit risk or manage risk going into that event, because we've heard so much threats and promises and then walkbacks of the tariff situation. Who knows what's going to happen next, right? It almost feels like the Trump administration doesn't know what's going to happen next, because they threaten tariffs, then there's conciliatory comments, then they threaten again, then it's then it pushes back, then they threaten again, then they lower the numbers, then they up the numbers again. It's just a complete mess at this stage when it comes to tariffs, and the markets have had a real troublesome time trying to define and limit risk when it comes to this. So look, in terms of the week ahead, the main focus, at least from a tradability point of view, is going to be on those US data points, because there we have a very clear bias, right? If the data comes in very, very bad, we would expect downside for US equities, downside for the likes of the US dollar. If the data comes in really, really solid, we would expect upside for the dollar and upside opportunity for US equities. When it comes to tariffs, it's a problem, because let's say we do get the 25% tariffs, that's obviously going to weigh on things like equities, but from a risk sentiment point of view, it could actually provide some upside potential for the US dollar. What if the number isn't 25? What if it's 20 or maybe even higher than 25? It's just, let's wait for the tariffs to come out, if it's going to come out, and let's assess how the markets will judge it. The problem with these tariffs is that, let's just say we do get a number of 25% blanket tariffs. Initially, that should be negative for risk sentiment. But it's going to be impossible for the markets to know just how negative that will be, what type of negative impact that will have on the global economy, right? Most people are expecting that to have a stagflationary impact, meaning downside potential for growth, upside potential for inflation. That's bad for business, bad for growth. But it's impossible to quantify how bad that will be. So let's just say we do get the tariffs being enforced at the start of April. It's going to take a whole month, basically almost 2 months, for us to wait up until May, to wait for the April data to see how that tariff decision impacted the hard data. So it's going to be very, very tough. It's going to be very tough to manage risk on the back of that. Again, the cleaner play in the short term, at least for this week, will be to focus on those US data points and to just play the volatility accordingly. And then let's wait and see what happens to tariffs, basically. That's going to be the main focus point. In terms of equities, levels to aim for, look, we're sitting on some pretty key levels of support once again for the S&P as well as for the NASDAQ, which we'll touch on in a second. We're sitting around those prior March lows for the S&P at the moment, at least going into the close on Friday. Key support, key resistance to watch. Look, obviously the first one will be that prior low from the 13th, coming up around that 5,500 mark for the S&P. If we were to see a continuation of risk of sentiment, so bad US data, high tariffs, and the markets freak out, key support there to watch after a possible break of that March low will be a move back down towards that 5,400 level. It's the implied volatility low for the week. It's also the lows for the S&P going back all the way to September last year. That'll be key levels of support to watch. In terms of key levels of resistance, in the case of really positive US data, maybe some conciliatory pushback on the tariff front, could be a possible move back up towards, firstly, the implied volatility high coming up around that 5,700 mark. And then, of course, the 200-day moving average. We can't forget that. That's going to be a critical one to watch from a resistance point of view as well. In terms of the NASDAQ, very similar looking levels here. Prior lows from March, obviously key focus around that 19,000 level. If that folds, a possible move back down towards the implied volatility low for the week. Also marrying up nicely, once again, just like the S&P, with those lows going back to September. September 6 around that 18,400 level. And then in terms of key resistance, same story, 200-day moving average above. And then just ahead of that, we'll have the weekly implied volatility high coming up around that 19,800 mark as well. It's going to be very important week. Watch volatility, watch the US data. We've got a couple of other events coming up as well. We've got Germany, inflation data coming out for Germany this week as well. We've got the RBA policy decision coming up on Wednesday. We've got some Swiss inflation data as well as Canadian jobs on Friday. But let's be honest, even though these things will or can create some volatility in the markets, the main focus will be those key US data points, what it means for stagflation, or at least for the views of stagflation, and obviously what happens with tariffs. That's going to be the main focus point for the week ahead. So as always, stay careful. Any questions, don't hesitate to let us know, and good luck with the week ahead. It's going to be a busy one.